Mark needs no introduction whatsoever. He's got uh, years and years of understanding of market cycles. He has a wonderful insight on how emerging markets evolve, and Mark was one amongst the first emerging market investor the world has seen. He started investing in emerging markets, I think, in way back in 1980s. He's a true blue value investor, and over the years I've interacted with Mark on various forums. He's always been a big India bull. I understand that his largest portfolio exposure is in India, and you will try and understand that what he makes of his India exposure and where according to him the world is headed. Mark, on behalf of everybody from ET Now, the Birla Voyage team, and millions of attendees, a very warm welcome and thank you for joining us.
Thank you for having me. It's a pleasure.
Mark, if I look at global equity markets, we are not far away from an all-time high. We hit all-time high in late December and early Jan, at least for India. And when we were at all-time high last time, there was no war. Oil was under 100. Fed was calling inflation transitory, and there was no energy shock. The four factors which I mentioned will change the medium and the long-term picture for earnings and for equity as an asset class. Yet markets have managed to climb the wall of worry. My concern is why?
Well, at the end of the day, I think people intuitively understand that with rising prices, which eventually are going to come, if you're printing money at the rate that governments around the world, particularly the US government, has been printing, you know that the currency is going to be devalued. And with devaluation of currencies, you have rising prices. And intuitively, people realize that in order to save themselves from these rising prices, they have to be investing in a area where the prices will rise with inflation. And equities are the best, because if you invest in equities in companies that have pricing power, that can raise prices in line with the increase in the prices of goods and services, then they're going to be in very good shape. So that's really why you see this continuously rise in indices around the world. It's very interesting. If you go back 10, 20, 30 years, you can see that there's been a continuous rise, of course, with corrections along the way, of equity prices, simply because you are seeing this devaluation of currencies. And with that, you have rising prices of not only commodities, but also stocks.
So, Mark, for an equity investor, looking at the way how interest rates are likely to go higher and there is a margin of shock, isn't there a fear of earnings downgrade and demand getting challenged? And if that is the scenario, which is the obvious scenario looking at where inflation is headed, don't you think that will have an impact on equity in general as an asset class?
Well, the interesting thing, if you look at pricing power of companies, why are they able to raise prices? Well, if they're raising prices, they've got to have consumers. And the reality is that the consumers are there. Why are the consumers there? Because wages are going up. If you look at the United States right now, you'll see that wages are going up, unemployment is going down. And of course, that means that prices can be raised by companies with pricing power. So it's really interesting to realize that at the end of the day, along with the rise of commodity prices, rise of consumer prices, wages are also rising.
Mark, do you think India is in a very unique and a special situation? China has got their own set of problems. Inflation in other emerging markets like Turkey is at an historic high. There are serious challenges in Russia that makes that market uninvestable if you're a foreign allocator. Do you think India, in a sense, even though expensive, becomes the only choice of preference, and that will ensure that the premium in India or the premium in Indian equities will remain elevated?
Yes, I believe India, of course, is in a very unique place. If you just look at the country itself, the population, The population age average is what, 26? For China, it's 36 or something like that. So you have a very young population, which means you have very productive and growing demands and factories and companies that can be more productive with a young workforce. That's number one. Number two is you've got a government that's bent on reform, on changing the mindset of the state governments around the country and of improving the lives of people through technology. And the emphasis on technology by the government is quite a unique thing. It's not many countries in the world that have emphasized technology in order to improve the lives of people. So yes, I would say that India is in a very unique place.
Mark, what do you make of the global headline, which in a sense bothered every large and long-term investor last week, which was that the global bond yields have inverted, and historically when that has happened, that has led to recession?
Oh yeah, for the poor bondholders are in trouble because with rising interest rates, bond prices, of course, are going to crash if you're in fixed income bonds. But even if you're variable interest bonds, as you know, variable interest bonds don't adjust so quickly. So you can be in a very bad place when interest rates are rising. But you must remember, that's one thing. Equity prices are a completely different thing. Very often the headlines confuse these two things. They say, oh, the markets are crashing. Well, they're probably referring to the bond market, not the equity market. So you've got to make a clear distinction between these two things.
Mark, last time when we interacted with you, you indicated that India was one of your largest exposure and you had 3 holdings in India. Is that constant? Have you altered that? Have you changed that?
I know we haven't changed it. We found incredible companies and we're just hanging on to those companies. No reason for change. If you find a good company, that's one of the things that's very important to remember, that you must make your selection of companies in which you want to invest very carefully. Take your time, do the study. But once you've done that and satisfied, you stay with those companies, regardless of what the changes in prices are.
Mark, at a global level, given that Indian markets have done well and we've outperformed, and if you compare India with China, Chinese markets are down and out, and some investors are calling them cheap. Are you tempted to go back to China? Are you allocating fresh money to India, or are you looking at going back to China?
We're looking at China. We constantly look at China. It's a big market, as you know, and it can't be ignored. But our preference has been for India recently because of the incredible changes that are taking place in the country and the path on which the country is embarked. But as you know, China's been hit with a lot of problems. They have a big debt problem with property companies. They have problems with concerns about their aid to Russia, which could involve sanctions by the West. Very unlikely, but it's possible and something that people think about. And more importantly, at the end of the day, the reforms instituted by the government to bring about a more level playing field, let's put it that way, in the market has resulted in downgrades by some of the biggest companies. And that has resulted in a downgrade of the index, the China index. That in turn has affected the emerging markets index, since China represents about 30% of the index. So all of these factors have been quite negative for China, but I believe they will pull out of that. As you know, interest rates in China are not going up, they're going down, and they should be able to pull out of this problem. But we cannot ignore China. We want to continue looking at it, but as I said, preference now is for India.
Mark, so you have 3 stocks like you mentioned in your India portfolio. When will you make that 5 if you like India so much?
Well, the problem with the index is that it includes a lot of problems, because the index is focused on the large liquid companies, and not all the large liquid companies are good companies. Are not necessarily the best performing in terms of management, in terms of ESG. As you know, we look at the environmental, social governance, and also cultural standards of companies. So it's not a good idea, we believe, to invest in indexing. We're better off being an active investor, looking at companies individually and making decisions on that basis. And it's paid off for us, by the way, because those of our colleagues who've been following the index were hurt badly with the situation in Russia. Russia represented about 6% of the index. And of course, immediately overnight, they lost 6% of their portfolio. So indexing can be very dangerous.
So Mark, as we look into future, to your mind, which is the moving variable?
The moving variable is the pace of technology adoption, I would say. As you know, with 5G, with faster chips, with all kinds of improvements in software, the technological revolution is right on top of us. And those companies that are not able to adopt new technologies to improve performance and profitability are going to be in trouble. So that is really the variable we want to look at. And I'm not just talking about software companies or companies that produce semiconductors or anything like that. I'm not talking about that. I'm talking about any company, whether it be in mining and consumer goods or in anything. If they're not adopting technology to improve their performance, they will be in trouble.
Mark, you've argued historically that ESG is the way world would migrate now. But given that ESG also is causing greenflation, and just for the benefit of our attendees here, greenflation is getting, greenflation means that companies are not able to scale up capacity because of environmental concerns. With so much of inflation, which is now really having an impact on everyone's life, and it is becoming more like a political issue, do you think there could be a dilution on ESG front in order to control inflation?
Yeah, there is a talk about that. And of course, India and China would be good examples of that. As you know, both countries rely very heavily on coal, which, as you know, is also very polluting. And it's extremely difficult for them to give up coal because not only does it represent such a large part of the power generation, but also because it's cheap. It's cheaper than other forms. So the movement towards cleaner energy has been inhibited by these problems. However, we're finding now that some of the renewables, wind, solar, etc., are becoming cheaper and cheaper so that they can compete with cheap coal. And that's one of the abilities for us to be able to get out of this conundrum. Nevertheless, at times of stress, like we're seeing now where prices are rising, there is a tendency to say, look, I don't care about the environment. I need my power. But that will pass. I believe that the governments around the world are recognizing that there are also costs to a bad environment. If you look at the medical costs, for example, polluting air results in lung diseases and all kinds of problems. So governments are beginning to look at this and do some triage to evaluate exactly what is the cost of a bad environment. And that's true of a company at the company level. The reason why we're interested in ESG is not because it's a nice thing, but because it makes sense in terms of reducing risk. If you look at the environmental factors, the social factors, governance factors, and also the cultural factors, and look at them closely, you find that they all contain ways to reduce risk to the company. So that's really the key, and one of the kinds of ways that we're able to have a win-win kind of a situation with these companies.
Mark, so let's talk about the market cycle. I mean, you've got years and years of understanding. They always say, and since you were associated with Templeton Mutual Funds at some point in time, that there's nothing called different. Same thing keeps on repeating again and again. So, where do you think this bull market cycle is? Because a bull market will start with disbelief, it will grow on skepticism, then there would be maturity and participation, and ultimately it would be euphoria and bust. Where are we in the market cycle?
That's a very good way of putting it. And as you know, the point of euphoria is not here yet, that's for sure. We're not in a period of great euphoria. We may get there sometime, but we're not there yet. And that leads me to believe, and should lead all of us to believe, that we're not at the peak of the bull market. Also, if you look at the timing, see, it's been about 2 years now that we're in a bull market, right? Usually these bull markets last for at least 3 years. The good news is that when the crash comes, it will be very sudden and it will not last very long. You have a crash, it comes down rapidly, does not last, the downturn doesn't last more than, let's say, half a year, and then the new bull market begins. And of course, those people that are able to get at the bottom can make a lot of money.
So, Mark, do you plan to ride the great Indian bull market for next 2 to 3 years?
Yeah, I believe so. You're not in a euphoric mood yet, that's for sure. And I think there's still room to go.
Would you be interested in the LIC IPO, Mark?
IPOs, as you know, have had some difficulties, not only in India, but in other parts of the world. But the move by the Indian government to privatize more and more of the state enterprises is excellent. It's a wonderful move, and it will bring great benefits to India, not only because of the improvements in the performance of these companies, but because it will put India on the map. As you know, at least half of investors around the world follow an index. And if India's weighting increases, in other words, if the market capitalization of the Indian market increases as a result of these large state-owned enterprises coming to the market, then investors around the world will be forced to go into India because it's part of the index, the bigger part of the index.
Mark, walk us through your investment process in a market which right now is going to be adjusting as interest rates will tighten. How can one make their portfolio slightly inflation proof?
Well, the best way to have a portfolio that's inflation proof is by investing in equities, companies that have earnings power. In other words, companies that are able to raise prices in line with the increase in money supply and the increase in the prices of goods and services. That is the best way. And of course, that means companies with very high return on capital and companies with low debt. Because with rising interest rates, companies with debt have real problems because their costs go up sometimes pretty dramatically as a result of the rise in interest rates. So that's the best way to protect against this inflationary period.
Mark, closing comments. What is your view on commodities and commodity stocks? Do you think commodities are in a bull run, but commodity stocks are pricing in a lot of optimism?
Well, commodities, of course, have gone up a lot, and they will go up as a result of the increasing money supply and the devaluation of currencies. However, commodities, investing directly in commodities, you may make money on the increase in price, but you won't make money by getting some earnings. In other words, if you invest in a company, whether it be a commodity company or any company, you're going to be getting earnings, you're getting dividends, which you won't get by just investing directly in the commodities. So investing in commodities is somewhat speculative. Now, when it comes to commodity companies, you've got problems because as a result of increasing environmental concerns by governments around the world, these companies are under pressure to spend money on pollution controls. And very often they're told not to even mine in certain areas because of the impact on the communities. So I believe it's not a good idea to be investing in these companies. In the short term, you may take some people want to take a speculative bet, but I don't think it's a good idea. You're better off investing in companies that use commodities but have the pricing power.
So if Mark Mobius has to choose between Indian stocks and Indian food, what would you choose always?
Both.
Well, Mark, really appreciate your time. You've been very kind and considerate with your time, and I know you're coming to India very soon, so look forward to meet you very soon.
Thank you very much.